Good morning, WFG and WSB. For this second presentation, or this now, because we talk about legacy, and I am very, 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 very interested in legacy. The reason why I'm interested in legacy is most of us from African descent, we don't think so much about legacy. We just think of, we are here. Okay, sorry, I'm seeing some questions here. How was she able to achieve the down payment for a house in a year, which is one of our goals? I've already told you, we're gonna aggressively invest. She's investing 3,000 right now, and she's gonna increase that because she has the 5,000 extra that we can see. So we're gonna open the first home buyers plan. We're gonna put more money there. She's gonna come work with me, and hopefully in the next 3 months or so, she's gonna get a license, and whatever she's making in WFG, she can put it towards buying a house. So you want to buy a house, you have to work harder, you have to make extra income. It's as simple as that, okay? So there are strategies and all of that. So now, what I want to share with you now is what I've shared with many families, and is how to leave at least 4 million inheritance. So you want to leave 2 million for Alex and 2 million for Christine. So there are 3 ways actually that you can do it. And then at the end, you will tell me which one you think is most probable.
Okay.
So the first one is you can actually buy real estate, which, you want to buy a house now. Already, we're talking of down payments. That's an issue right there. Do you have the 100,000 to put down now? No. So that means you cannot do that right now. Yes, you're going to be able to do it in the future, but you can't do it now. Okay? Except you have an inheritance from your dad or your mom.
We don't have, no one has inheritance. So let's move to option 2.
I'm sorry. That's why we need to give inheritance to our children.
Okay.
You can buy stocks or mutual funds also. You can invest in that. Or you can invest in life insurance. Okay. Those are 3 major areas that you can invest in. Now, if you want to buy real estate, I checked, I see that the approximate growth of real estate from 1982 in Canada to 2022 is about 3%. If you use the rule of 72, your house price will double every 24 years. So if you buy a $500,000 house, and in 24 years, that house will be worth $1 million. If you have a 25 years mortgage on this house, that means the house is mortgage free and you have an asset that is worth $1 million. But we want to give it to them in 48 years. 48 years will be around 88. You are, I know God will help you. You will still be around. So we want this asset to be 2 million so that Alex can have 1 and Christine can have 1. So house A, what you need is 100,000. The property in 48 years is worth 2 million. Your initial investment is 500,000, which is the purchase price. Now the capital gains is automatically, of course, it's 1.5 million, right? So taxable capital gain on that house is 750,000. So when you are giving this house to Alex, you have to pay, you or Alex, one of you must pay this $375,000, which is the tax that is due on the transfer of the assets. Okay.
Yeah.
And since you are doing 2, excuse me, since you are doing 2, 1 for Alex and 1 for my dear Christine, you will be paying 750,000 in taxes, and that means this is what you need to start today. You need to have $200,000 to start today.
Oh my goodness!
I know that you don't have that now, so you cannot use this strategy. But it's not a bad strategy if you have the 200,000.
Assuming we have the cash.
Now, the potential problems that you also have here is that the down payment, that's the number 1, and then Do you have the capacity to close the property? Do you have the capacity to get 800,000 mortgage apart from your current house? Because people talk about, oh, I'm just going to
Maybe
buy a
not.
house.
Maybe
Yeah,
not.
okay. If you have the capacity to get the mortgage outside of, so that is 400,000 mortgage on each house. That's 800 plus your 700. Do you have capacity to get $1.5 million of mortgage?
Not likely.
Maybe not. And then if you are able to do all of this, what about, God forbid it, if you have uncooperative tenants and you have different issues? So those are the things that come with that terrain, but that is how buying real estate is, okay?
Okay.
But the other one is you can invest in stocks. Now you can, I know that some of you know how to do this. There are financial calculators. I've used it before. Now I'm going to ask for like 10 more minutes so that we can, I'll finish it in like 10 minutes. Trust me. I also have an appointment to go to, but let me show you how I did the calculation. So there is dynamic. Now I won't be able to explain a lot to you guys. I'll just go straight to it. There's dynamic calculator here, and there you can use any investment calculator. Okay, so what I did, I come here and I want to see if I invest 2,500 a month. Kenny, we don't have that money. Come and work with me. Let me show you. You need to increase your income. You want to build wealth for your family? Don't sit down and say, Kenny, we don't have the money. Let's get the money. Change your mindset, you change your life. Come and I can teach you, I can show you, okay? Now, you invest 2,005 a month for the next 25 years at 7%, that will give you 1.9 million. But that's not what we're looking for. Now, 1.9 million, now you've stopped investing. You've stopped contribution. 1,968,673, that's what we now invest. Remember, we are going to 48 years. So 48 minus 25 is 23 years. And we're not doing anything monthly anymore. So this money, if you keep $1.9 million in an account, growing at 7% for the next 23 years, you don't touch it, you will have 9.332,553. Wow. Can you believe this, my dear?
It's mind-blowing. But
It
the
is.
power of compounding interest.
Power of compounding interest. That's what I show people. When you start, it may look small, but trust me, if with discipline and you continue to do what you need to do, your family can be wealthy. And that's what is in the blue book too, that just make sure you are disciplined and continue to do it. All right. So this is what it is in terms of looking at it in terms of presentation. Okay. Now you put 250,005 monthly. So in 25 years, that money is 1,968. I've shown you. And in 48 years, it compounds to $9.3 million. I love this. Now, I invest 750 over 25 years. And at the end of 48 years, so at the end of 25 years, I stop putting money there. Remember, you are in retirement at 65 now. You are 65, you are in retirement, you don't want to be putting money anymore. You are thinking of your own retirement, not any generational whatever. But whatever you have done up to that point is 1.9 million. We continue to invest it. By the time you are now in your 80s, 48 years from now, this money is $9.3 million. But hey, we have capital gains. Because if you invest 1.9 and you now have 9.3, your capital gain is 8.5 million.
Take half of it.
Sorry?
Half of it will be taxed.
Yes, my dear, I'm sorry. Yes, because you are investing in taxable assets. So 50% taxable, because what happens is if you pass on, let's say at age 85, it is called, you already said it, deemed disposition. And then the government is going to tax their estate and pass on the money to the heir, who is your children. But Canada government will be rich to the tune of $2.1 million.
Anti-bypass estate. Estate bypass.
If you want to, no, this is not even estate bypass. This is tax.
I
This is
should
tax.
be able to. Can't I
So
use
this,
any of those tax advantaged tools to achieve this?
yeah, you can, but there's none. I will show you only one that is available because
Okay.
TFSA, you can only put like $500 in a TFSA account. That's it. By the time you put more than 500, you have over contributed and you'll be penalized. So the only way you can do it is outside, which is called a non-registered investment. Okay. But don't worry, I'll show you what that means. Now, the net asset to your children is still 7 million. It's not bad. At least pay government their taxes, man, so that they can give us good roads, they can give us good healthcare. You know, why not pay to government? But what is the potential problem here is the discipline. Most people can this money in this account, they will spend it, they will go in there, they will do something. They will say, oh man, you know, and
I live once, let me go for one trip, one
exactly.
splendid
Another
trip.
problem we might have is, God forbid, if the market turns, particularly when the debt occurs, then the value may not be as much as 9 million, but maybe 7, 8 million is still okay. But at least that is what it is. The final option that I'm going to show you is using the same 2005. Why don't we do a UL strategy? So with a UL strategy, you can actually buy $4 million from day one. Oh, Kenny, really? I can buy 4 million? Yeah, you can buy 4 million and you can pay 2005 monthly for the next 25 years. So this is not different from scenario 2. You have the 2005, but you are just using a different strategy now. Okay, let's look at it. So total amount invested is the same 750. In 25 years, in the 25th year, you will have 1.4, assuming 7%, you will have $1.465 million in your cash value. So this is the one you can touch if you want to touch anything. Remember, you are 65 now. In 25 years, you can invite me and my lovely wife. We can go to Bahamas with you and a couple of your friends. We can celebrate your 65th birthday. And if it is the 70th that you want to invite us, you have money. You can come here and take money. You like that?
Sounds good.
And
But I think we can do more.
Oh, you can do more. Okay, let's do more. But remember, the death benefit is still there, $4 million. So, and this life insurance is now fully paid because we said we want to pay for 25 years.
Okay.
So we're not praying for this, but God forbid if that were to happen, the death benefit will be paid tax-free to your heirs. So that means this entire 5.4 million, if it happens at that time, it will be paid out to them. But in 48 years now, we left this account, we are not paying. You remember, you're not paying again. In 48 years, your cash value is now 3.8 million, and the life insurance is 4 million. So the net asset of this policy is $7.8 million. Now, are there potential problems? Yes, there are.
Yeah.
But the potential problem basically is if you don't pay. That is the risk here, if you are not disciplined enough. But if you are disciplined, just like in the investment side, your family gets 7.8. Now, and I can show that to you very quickly before we round up. This is how that one works. You can use male, female. And just let me use male because I did it for male before. And this male guy bought $4 million of coverage for the legacy, and is 40-year-old and is paying $2,500 monthly. There are different ways we can run this, but let's just be consistent with what we've been doing before. $2,500 and to age 65 only. Age 65 is not paying forever, and we are estimating 7% rate of return. And what I would advise you to do, ladies and gentlemen, run this same scenario with Ivari, run this same scenario with Industrial Alliance, whichever one gives your client the best cash value and all of that. That's what you should use. That's what I do all the time. I make sure I look for which one is going to give my client the best. So account value protector. Okay. So let's run this and you'll see that is exactly what I showed you that is there. So at the end of, so you can see right there, the plan minimum is that. Maximum, you can actually put $10,000 there a month. You can put 130,000 if you have. Remember the guy who has 100,000 to put for a house? The strategy could be, oh, instead of buying the house, I want to buy this insurance. And you can put lump sum, but we can do whatever we want depending on the plan. So let's look at this plan. At the end of, so this is our plan. We're doing 2,500 every month for 25 years. That's what we estimated. Remember, I said 1.4 is the cash value that you have. There's something
At
that
year 25.
Yes, there's something that I didn't do that I should do. Let me just quickly do that. So you want to have all the years, okay? You want to have all the years. Now, there are a lot of things that I can share with you here, but because of time, I won't be able to. And you can reach out to your SMDs. They know how to do this also. Because basically, I want to share with you, like, I think I will just touch on that. So that because we want you to be able to withdraw from this policy tax-free when you are ready. Okay, so if you look at this now, right, my time, I have about 3 or 4 minutes to go. Now, if you look at this, by the time you are 65, you have 1.4 million. But look at this, as you continue to grow older, your asset is growing old. Oh, sorry, I said growing old, growing fast. Look at that. At age 85, this is where I got the 7.7 this million. But we're looking at 48 years from now, from today, $4 million cash, $8 million inheritance. If you do not touch this policy, 48 years from today, we're talking of $8 million. I ran some numbers, maybe I didn't know, but regardless, so you can see it right here, $8 million. Now, I said I want to show you that you can, if you know your insurance very well, there's something called ACB. ACB is adjusted cost base. This is the amount that you can withdraw tax-free, sure, depending on when you withdraw. So at age 65, you have 370,000 that you can withdraw tax-free from 1.8 million, and you leave 1.1 million there, and so on and so forth. Of course, the longer you wait, it reduces. Okay, so if you want to make a withdrawal, do it before age 70. Also, you can see that there are no shuttle account, no transfer, no taxable gains. Everything is fine, no tax. So by the time you reach age 85 or age, this is 48 years, that's what we're looking at. By the time you reach 48 years, where is it now? Right here. 48 years is when you are 88. If you have not touched this policy, what you're actually leaving for your family is $8 million. So this is the question for you that I have for you. Out of all the strategies that I've shown you today, which one will you prefer? Will you buy the real estate and in 48 years you leave 3.2 million after tax? Will you buy stocks, leave about 7.1 million approximately after tax? And or will you do investments in insurance? Remember, with the insurance option, if anything happens in 5 years, your family will still get 4 million. Not the same case when you're buying stock, because when you buy stock, you need time, a lot of time for it to grow. Look at the time. You need time. You see, if something happens in 5 years, all you have, at least it's 2 million. It's not bad, minus tax. But if it is in insurance, 4 million is there. If something happens in 10 years, you have 3.8 million minus tax. In insurance, 4 million plus the cash value, and so on and so forth. And it continues to grow. Just the same way this one also grows, it continues to grow. So which option, my dear, do you think is probable, is possible to do, or you will prefer?
Obviously option 3, but I have a quick question with option 3. And that
Yes.
question is, if I were to approach an insurance company right now asking for a 4 million UL, wouldn't I be subject to, medical tests, everything? The insurance company wants to make sure that I'm actually fit and okay before they take this as an underwriting case that they'd like to take on. Just a question.
Do you have any concern about that? Are you healthy?
No. I don't have a concern about that. I'm just asking, like, I would expect that they would ask you to go through medical tests.
There will be medical tests. I thought what you'll be asking me is, Kenny, I don't have the money to do it, even if they will approve me. So, but
you said I should come and join you now. We'll be making $3 million a month, and then I can be paying this.
Okay, yeah, I see that you got it. So, yes, yeah, they will do medical tests. They will do all of that. But trust me, if you are healthy, and that's why you should do it now. You don't have any medical condition. You are not using medication. Your health is good. That's when you should do it. Okay. And that ends our presentation.
Thank you.
I know that you guys have questions. Unfortunately, I will not be able to entertain questions. I'm so sorry, guys, because I have a meeting. I have to be there in the next like 50 minutes. I have to drive to that meeting. But those topics, they will open the conversation that you can have with your client, and it's a different